And I guess from a consumer perspective as well too, which is what's driving a lot of this, is we're seeing weakened consumer spending and investment, and ultimately consumer confidence has changed. And that's not surprising, because when things are a little bit more difficult or when things are a little bit more uncertain, if you think about how you respond as a household, what are some of the things that you do? You kind of hold on to your pennies a little bit more, and you're a bit more conscious about when and where you spend your money.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again and back on the 360 Money Matters podcast.
Andrew, we are back again and doing a market wrap today. It's that time of the month.
Yes, absolutely.
Your favourite time, your favourite episode?
Yeah, I don't know if it's my favourite episode, but I do enjoy the market wraps. On the contrary, probably Billy's least favourite time. Billy's not so much of a fan of the market wrap episode, so maybe we'll put it out there. If the public is not enjoying the market wrap episodes, we might need to put a stop to it. Otherwise, Billy is going to lose even more hair.
Actually, I've got a pretty good set of hair. So anyway, not too bad of an issue there. But no, it's just that we're just fronting up, digesting, regurgitating information, right? And I'm not saying that there's not value in that, but I think the problem is that I feel like I can't put my spin on it. Not my spin, that sounds really bad, but the jovialness that our viewers and our listeners love and are accustomed to, I kind of find it hard to put it on there because, today the Standard & Poor index is up by 4.3. Anyway, Andrew, before we get completely sidetracked,
you just gave us the starting point, Bill. There you go.
We're going to start in the US, and we're talking about, so at time of recording, S&P 500, which is the index that we always talk about during our market wraps, is up a whopping 4.36%. That is absolutely huge
on the month.
How's that for it?
Yeah. How's that for a start? There you go.
Okay, there you go. There you go. Now you can carry on with it.
Yeah. So look, we're seeing the US market have a pretty good start to the month. That's off the back of markets being quite volatile previously. So we did see in the previous period markets taking a pretty hefty dive as Japan decided to increase interest rates for the first time in 30 odd years. So we saw markets reacting pretty negatively to that overnight. And now we're seeing the recovery post all of that happening. So 4.3% for the month is some pretty good data coming out of the US.
Yeah, it's decent. I mean, you consider what's sort of happening in the United States. I mean, we've got the election coming up, which we'll talk about in a sec. But I think one of the things that's given the market confidence in the US and especially what we're seeing with this return for the month so far is that the Fed Reserve are coming out and actually talking about, and they're the ones that are leading the charge on this. It's not surprising, but they're talking about when they're going to reduce interest rates.
Yeah.
So they're the ones that are coming out and saying, okay, we're looking at what the data's doing and we feel like we're at a particular point in the cycle where it's time to go again. And what that does is that gives the market confidence that the Fed are responding to the economic data and they're actually using it the way that it's meant to be used as a lever to try and either stoke or slow down the economy.
Yeah.
And I think that's a really positive thing because businesses like certainty and obviously markets like certainty as well too, and hence the result that we've seen, 4.36%.
Yeah, and it's interesting. I mean, we're now at a point in time, both globally, or particularly in the US, but globally where, okay, the ECB, so European Central Bank, has dropped interest rates. The Fed is likely to reduce interest rates in the near future. So we're talking about US dropping rates. Which is also going to then potentially put some pressure on the RBA to start reducing interest rates, albeit I think that it's still quite early for that.
We hope. Yeah. We hope it's going to put pressure on them.
Yeah, we hope. You can tell that Billy and I have a mortgage. So realistically, what we're seeing is markets responding positively to the fact that, hey, we might be at the end of the tunnel in terms of interest rate rises and potentially starting to look down the barrel of interest rate declines, which does give at least property investors a lot more confidence as well. So we may start to see the property market responding to that too.
Yeah, well, time will tell. But let's talk about probably the last thing in the US, but the thing that's grabbing all of the headlines at the moment is the presidential race between Trump and Harris.
Yep, no one does elections like the US, do they?
It's like what's it called? It's like a national sport. It's crazy how much money they spend on this stuff. And we've got 3 odd months to go because the elections is held in November.
Yep.
So yeah, that's just basically consuming pretty much all of the media outlets because there seems to be something different happening each and every day. And it's just funny how this thing just takes on a life of its own. And it's crazy.
Yeah, and look, you do see things happen and impact markets pretty heftily when there is a US election year. So, for example, we saw Robert Kennedy Jr., he decided to throw his support behind Trump. And so he's pulled out of the swing states in order to be able to give Trump a leg up there. And so you see markets start to price in Trump's policies more. And so it tends to be a fairly volatile period of time in the US when you're talking about especially when it's closer to election. So it's very interesting to see where that's ultimately going to land and how that's going to impact investment markets as well.
He took his bat and ball and went home by the sounds of it. Yeah. Because he's basically changed sides, right? He was a Democrat, yeah?
He was a Democrat,
but he was running as an independent.
Yeah. Now he's jumped onto the Republican bandwagon. So you almost can't call it.
So that's the perfect what's it called? When you see something play out, I've lost the word, but basically, if you can't beat them, join them. Is that
maybe that's what it is? Look, yeah. I don't know. It's hard to speculate, particularly when we still haven't had an interview with Kamala Harris, so we haven't actually had the luxury of knowing exactly where her policies are going to be and how that's going to land. So
I don't think she knows either.
Well, ever since she's been elected, we haven't seen anything come out yet. So it's going to be interesting to see where that goes and how that's going to impact markets.
So glad we live in Australia and don't live in America. So on the Australia note, so the ASX 200 has increased 2.05% over the last month. So we've still got a little bit to go at time of recording in terms of where the month has played out. At the time of recording, about half of the companies on the ASX have reported their results.
Yep.
That represents more than half in terms of market capitalisation. So although there's still half the companies to go in terms of how much weight they have on the ASX, some of those results have been in line with expectations. Some of them haven't, but all in all, I think it's been pretty smooth sailing around some of the results that have come out from there.
Yeah, and look, there's been some fluctuations in commodity prices, so that always presents a bit of uncertainty, particularly with iron ore and coal in Australia, given that we're so reliant on that, which has impacted performance of mining stocks. I think the biggest thing within Australia is probably the RBA. So what the RBA is going to do in their next meeting. Now, at time of recording, we're talking about the market pricing in a 20% chance of an interest rate decline. Now, the reason that that's quite interesting is if you look back to the start of the month, or you look back to the point in time when we saw markets drop off the back of the Japanese central bank dropping interest rates, there was a 70% chance that the market was pricing in a 70% chance of the RBA dropping interest rates in the next meeting. Now that sentiment has completely shifted. So it's probably unlikely that we're to see the RBA drop interest rates, but that fueled some of the earlier growth in the market and a little bit of light at the end of the tunnel potentially for mortgage holders in Australia.
Yeah, probably a couple of things to add to that, Andrew. Just going back to the iron ore, the government, when they're factoring in the budgets and the revenue that they're going to receive, a lot of the GDP that Australia generates is from the mining sector, and in particular, let's call a spade. It's iron ore. See, yep. Spade, mining, see how that all worked in. Anyway,
and you said that you couldn't throw in your natural flair when we're talking about
I'm definitely trying, right? So looking at the iron ore price and where it's heading to, it's starting to get into that territory where the government are earning less and less money off that. So that's going to put additional pressure onto the budget. And, you know, if you look at the budget deficits and the budget surpluses that we've been running in different periods of time, a lot of that has really changed in line with what the iron ore price is doing. So that's going to be interesting to see what happens from that perspective. And then coming back to the RBA and their decision, I mean, look, it's interesting because everybody's talking about the RBA needs to make a decision and it's what they're going to do and it's what they're up to. But on one hand, the RBA have come out recently and said that part of the stuff that the government is doing in terms of the money that it's spending is inflationary in nature.
Yeah.
So the RBA can almost do whatever it wants, almost. And if the government keeps spending, this is what I'm understanding of it, but if the government keeps spending the way that it has been spending, then unless those two things are working together, then they're kind of working, well, they're working opposite one another.
Yeah.
So I don't know how that ends up playing out, specifically in Australia, because there's so many infrastructure projects that the government have got happening at the moment.
Couple that with the reduction in tax that
The stage 3 tax cuts?
Yeah, stage 3 tax cuts that ultimately landed more money in people's pockets.
Yep.
And it doesn't paint a very good picture for inflation. Which I think there's been a lot of pressure on the RBA in order to be able to, you know, not just consider inflation in their metrics. And we have seen the RBA actually pushing back on that. So the RBA has been pushing back and saying, look, we are still considering inflation as the primary metric of whether we, you know, decrease or increase interest rates. So it's a difficult one to see where that pans out eventually. I think the big thing within it is whether you look at a time frame of 6 months, 12 months, it's likely that, you know, the RBA is going to be reducing interest rates because there's going to be pressure to do so, particularly, you know, European banks are decreasing interest rates, which we'll talk about in a second. We're looking at the US potentially decreasing interest rates in the very near future, and so there's going to be pressure on the RBA as well.
Fingers crossed, Andrew, for all of those mortgage holders out there that it does go down sooner rather than later, right?
Yeah, absolutely.
Us included.
Exactly right.
Andrew, speaking of Europe, what are we seeing over in Europe?
Yeah, so look, Europe has had slower than expected growth. So we've seen the Eurozone really not performing very well at all. And some of the reasons that we saw the ECB dropping interest rates was actually in order to spur on economic growth, which is never a very good sign. So there's some concern in the European market that, hey, yep, inflation's under control, but we're now at a period where economic growth is negative. So hopefully that, you know, potentially gives some insights to central banks around the world that, hey, if you increase interest rates too hard or if you push it for too long, you can then need to decrease interest rates in order to spur on economic activity, which can be difficult to do because it doesn't necessarily work that quickly or that easily.
Yeah, and that's what we're seeing. I mean, in terms of market sentiment, it's moving all over the place, and that's the reason why. Because, you know, it's kind of like when things do get out of control, more influence is needed to bring it back in control.
Yeah.
Whereas if it's done slowly, you know, kind of like the frog in boiling water, I guess is a good analogy. But that's exactly what we're seeing with the sentiment over there. So that's not surprising.
Yeah, you couple that with some of the geopolitical issues that are happening. I mean, in the Eurozone, particularly when you're talking about Russia and Ukraine, but then you're, you know, looking at around the Eurozone, so not too far away in regards to what's happening in Israel and, you know, all of the surrounding countries around there. It's there's not only economic concerns around the Eurozone, but there's also geopolitical concerns, which eventually will likely result in economic concerns. So there's a bit of uncertainty.
Yeah, I mean, the two are correlated, right? So moving across to China. So the Shanghai Composite over the last month at time of recording has decreased approximately 1.3%.
Yeah, which is significant, particularly when you look at, you know, 12 months from today, Shanghai Composite's down about 8%.
Yep.
So we are seeing the Chinese market, in essence, going backwards compared to, you know, where you normally see, a normal growth year in China historically has been an absolute boom in Australia. So when you're talking about a decline in China, that is a massive crash in the Chinese economy. So there's some concerns, significant concerns around what's happening in the Chinese market.
Yep. And I guess from a consumer perspective as well too, which is what's driving a lot of this, is we're seeing weakened consumer spending and investment, and ultimately consumer confidence has changed. And that's not surprising, because when things are a little bit more difficult, or when things are a little bit more uncertain, if you think about how you respond as a household, what are some of the things that you do? You kind of hold onto your pennies a little bit more, and you're a bit more conscious about when and where you spend your money. So if you go and then expand that out over an entire country or a continent, then obviously you start to see consumer sentiment really shift markets. And, this is what we're seeing in China as well too. I think there's still a little bit to play out in the property story as well. So that hasn't completely figured out what it's doing yet as well too. So not surprising that we've seen over the past month that the index is down.
Yeah, absolutely. So there's still calls for the Chinese government to really step in and through regulation and through some incentives actually spur on the market. Now, they've addressed some of those concerns in the past, but it really hasn't fully been addressed. And so that's part of the reason why we're still seeing some negative growth coming out of China, which, as our largest trading partner, that weighs in on the ASX, which is part of the muted growth that we're seeing in the ASX. So, yeah, it's going to be very interesting to see how that one plays out. Although, and this is probably more gut feel than anything, so not what you want to be doing when you're talking about a market wrap segment, but it feels as though the reliance on China has decreased significantly in comparison to where things were sort of a couple of years ago. Mm-hmm. A couple of years ago, it's not, but China sneezed and Australia caught a flu, so that was anytime you saw any concerns around the Chinese market, you saw the Australian market performing very significantly in the negative direction, whereas now, despite everything that's happening in China, I think Australia has started to transition out of being so heavily reliant on China, despite them still being one of our largest trading partners. Yeah, subject to what we're talking about specifically with iron ore, because iron ore is still taking, or China's still taking the lion's share of our iron ore exports as well too. So going back to that earlier point about commodities and what's happening in Australia, obviously because of the slowdown in China, they don't need to build as much. There's not as much steel. We're talking about property as well too, so that's starting to, stagnate a little bit more and what have you. But you don't need as much iron ore in order to produce the steel in order to build the buildings and build the infrastructure. So yeah, it's all tied in there. But you're right in terms of our other exports and even iron ore to a certain extent. But where are we moving that to? Obviously needing to find another home other than just China. Yeah. If there's not as much demand, obviously supply and demand, it's going to change the impact of the price, and it's going to bring the price down, which is what we're seeing. Yeah, exactly right. Bills, I think that covers it in terms of what's been happening and where things have been at over the last month or so in terms of markets. Beautiful. Andrew, hope you enjoyed that one. Always. Hope you did, Bills. I did enjoy that. And to our listeners and our viewers, hopefully you got a bit out of that. If you want any further information, reach out to Andrew and myself. Details are in the show notes. As always, like and subscribe if you haven't already. Share it with family and friends as well too if you haven't already. And Andrew, look forward to catching you on the next podcast. Thank you, Bills.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaridis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.